Hi, thanks for joining me for this presentation on 1031 Tax Deferred Exchange Basics. I'm Bill Bird with the Bird Property Group, Keller Williams Realty in Charleston, and I've been licensed since 1986 and handled lots of 1031 exchanges over my career. And during that time, I've discovered that this is an incredible tool for real estate investors that not every investor actually knows about. So if you're a real estate investor and you don't like leaving money on the table after a transaction, we've got some really good ideas here for you. You're going to discover how you can defer up to 4 levels of taxation on your real estate transaction, which is in turn going to leave you more money to reinvest and leverage into other real estate investments to get greater return on investment for your whole portfolio. So let's go ahead and jump right in and take a look. So let's go ahead and take a look at what we're going to learn today. First, we're going to look at what a tax deferred exchange is and why now is a great time to take advantage of a 1031. And then we're going to look at some other reasons that you would want to do a 1031. We're going to talk about the 4 levels of capital gains tax on a real estate transaction. We're going to look in detail as to what the definition of a like-kind property is. Then we're going to look at the exchange equation and the different types of scenarios that could occur in that and actually cause you to have some capital gains tax. Then we're going to look at the process of a delayed exchange and the time requirements there. We're going to check out the property identification rules and what some parking arrangements may look like. We'll take a look at the code, the 1031 and the 121 code in the IRS code and what that means to you as a real estate investor and a homeowner. And last, we're going to look at a little bit about what the third-party intermediaries are that help you with the transaction of a 1031 and properly handle that. So basically, to start this presentation, I want to let you know that it's important that each investor, each taxpayer and business owner review your specific situation with your tax and legal advisors. And ideally, you're going to want to do this well before you negotiate the sale of a property that you're going to be using in an exchange. So in this overview of the 1031, I'm going to pack a lot of information in here in a short period of time, and I also want to let you know that I'm not going to go into a lot of great detail on any one particular topic, but for those of you that are new to exchanges, I'm sure this is going to give you a great introduction as to what they're all about, the timelines and deadlines, and the process that's involved. So 1031 exchanges, they're a vital part of our tax code, and at the top of the screen you'll see IRC section 1031. Now that's the section of the code that provides the guidance for this tax strategy, and this vital aspect of the tax code provides real estate investors with a significant tax advantage should they choose to use it. Now this code will give the investor the ability to defer taxes on the sale of any real property that is held for productive use in business or for investment. What it does, it allows the taxpayers or business owners to potentially defer up to 4 levels of taxation that would otherwise be incurred if the investor did not do a 1031 exchange on the sale of a real estate asset. So 1031 exchanges, they've actually been around since 1921, and with a 1031, the rationale behind the tax deferral is that there's continuity in the investment liquidity when a taxpayer sells a piece of real estate that they've been holding for investment or using it for a business, and then they reinvest all of the proceeds into another like-kind property. So in a 1031 tax deferred exchange, the investor is not actually receiving the cash proceeds. The cash or equity is going from one investment into another investment. Therefore, the deferral of these capital gains taxes is what actually makes the 1031 a very powerful strategy for business owners and real estate investors looking to leverage and improve their investment returns. Now, right now, what we have is what we call the perfect storm for 1031 exchanges. And really, that's being driven by a couple of factors. One is that the current administration is looking to increase capital gains taxes significantly. And over the years, certain groups, they've tried to remove the Section 1031 from the code on several occasions. So maybe it might be a good time to take advantage of it while we still have it, because it definitely has had a target on it over the years. So recently, additionally, there was a new tax added probably about 6 years ago that's known as the net investment income tax. Now, this tax was added on capital gains taxes for certain high wage earners. So with the possibility of higher capital gains tax rates on the way for real estate investors, the 1031 exchange may become more popular and useful in the next few years. Now, coupled with that, we've got very strong markets. From the stock market to real estate, we've seen several good years. In fact, right now, even in the wake of the pandemic, the markets have been doing incredibly well. Residentially, commercially, nationally, we've all seen very strong markets in just about every area of the country. So what that means is that investors have seen significant appreciation in the values of their real estate assets, and this has also led to rising rents. So the bottom line is we have taxpayers that own investment properties that have increased dramatically in value, that now they can look to a 1031 as a way to potentially defer paying taxes and effectively pushing that tax liability into the future by acquiring another asset that may provide greater leverage and greater return on investment. Now, there are a lot of reasons people look at doing exchanges, and we're going to go through a couple of those right now. The first is to obtain more leverage. If a taxpayer has a lot of equity in a property, they may not be getting the best return on that investment. So they may want to exchange out of that asset and acquire another property with more leverage to get a better rate of return. The other reason would be diversification. Some taxpayers will diversify in one of two ways. One would be geographically. Let's say they have all their assets in one town or area of town, and they may want to diversify into another area where the area may have different economic conditions that are attractive. Then some investors may want to diversify by asset class. This would be where if you have an investor that's acquired a lot of single-family homes over the years, they may want to diversify into multifamily, industrial, or some sort of commercial property. So you see, you can diversify both geographically and by asset class. Consolidation and management relief are another two motivations for doing a 1031 exchange. Consolidation is very popular. This is where if someone has acquired a lot of single-family homes, they may want to consolidate those assets into one larger multifamily building, for instance, that may provide management relief because it being in one location, it may be a little simpler to manage. Cash flow is another powerful motivator, especially in our area. You have a lot of people here that own land, own raw land, and they're not farming it, they're not leasing it out. They're not using it for timber or any other purposes that produce cash flow. So a lot of times what we'll see is a landowner may sell a large piece of property and take the cash proceeds from that and put that exchange that into another asset that may be producing monthly income, such as an apartment building or rental homes, vacation properties, those type of assets. Then there are other investors that will do a 1031 so they can increase the potential for appreciation and their depreciation. So what we know is that as properties go up in value, so do the opportunities for greater depreciation and depreciation and appreciation. It's just another strategy that's out there that people use. And then finally, there's estate planning. This is where some older taxpayers that may have a lot of equity in a large property, they may want to exchange out of that property to produce some sort of estate planning for buying other homes for, say, family members, where they may allow them to, quote, pre-select their inheritance. Or they may want to do an exchange into something like a DST, which is another real estate vehicle that I'm not going to go into detail here, but it's a way of exchanging into a simpler asset that's professionally managed. But anyway, those are a couple of the ways that people are doing things and some of the motivations that are encouraging people to do 1031 exchanges in our market. Now, as a real estate investor, you really have three strategies with your real estate. One is to buy and hold. Many taxpayers will do this. They buy a property, hold it for the long term, they pay down the mortgage, and then slowly bump the rents up as they go along. Great strategy. Lots of people do this. Now, a second strategy is to buy and then sell the property. So you sell the property and then you pay all the taxes owed. And here you could potentially be paying all four levels of taxes. And you'll have the after-tax equity that you can invest in things outside of real estate, like stocks, bonds, mutual funds, energy, commodities, etc. And just to let you know, there are many investors that do this, and this might be part of their long-term strategy to actually diversify out of real estate, which is fine if that's in your plan. But there is one thing that I want to point out here, is that it's very difficult to obtain the same rate of return with after-tax dollars that are invested outside of an investment in real estate versus keeping all of your gross equity in the real estate and redeploying that into another investment property. So purely from a return on investment standpoint, there might be a little hit when you do this. So again, many investors may want to diversify out of real estate in the future by using a 1031. They can actually postpone that tax liability, pushing it into the future. However, there will be a point at time when they will want to go ahead and liquidate their real estate, pay the taxes owed, if that's part of their long-term strategy. And then finally, with the 1031 exchange, investors can do a fully deferred exchange. That's where they pay no capital gains taxes and defer all of those taxes into the future. Or some investors may opt for what we call a partial tax deferral. Now, here they'll sell a property and buy one or two replacement properties, but they may receive cash out of the transaction. And if they do receive cash out of the transaction, that's called cash boot. Now, any cash pulled out of the transaction is going to be taxable. Also, if there's a reduction in the mortgage amount on the replacement property, that mortgage boot is going to be taxable as well. So with that said, investors will still proceed with a partially deferred exchange and take advantage of what the 1031 exchange offers them and be happy to pay some taxes on that boot if they want to pull that money out. It's just another strategy that's available within the exchange process. So now let's take a look at the actual code itself. The tax code says this: no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for the real property of like kind, which is to be held either for productive use in a trade or business or for investment. So let's take a look at that. So number one, when we look at the first line, this is what we call a non-recognition treatment. So what happens here is the cash or the tax liability follows the taxpayer from the relinquished property, the one you sell, and that basis gets rolled over into the replacement property, the one you buy. So the taxes actually don't go away. Sometimes you'll hear people incorrectly call a 1031 a tax-free exchange. That's actually incorrect. It's tax-deferred, not tax-free. We're actually pushing the tax liability into the future, and it's called a non-recognition treatment. Now, there are lots of types of properties that qualify for a 1031, and they're very broad. It could be an investment property for another investment property. It could be a business property for a business property. It could be a single-family house for land. It could be an apartment building for a commercial office building. So the whole concept is very broad, and the term like kind, which we're going to discuss in a little more detail, obviously is very broad, and it's real property. Real property is real estate, and personal property does not qualify for a tax deferral. Just looking at real property. There are some exclusions from the 1031 exchange. And now the first would be stock and trade, or another property held primarily for sale. The first, stock and trade, it's typically going to be inventory that's held in the ordinary course of business that's held for sale to its customers. So it could be somebody like a home builder or a home flipper, someone that's holding inventory to sell it, or other property primarily held for sale. So if the intent of the taxpayer is to hold it for sale and not a long-term investment, it will not qualify for a 1031. And when we say long-term investment, we generally mean income producing, unless it's bare land. On this slide, it shows all the different types of like-kind property. As you can see in the upper row, you see a farm, a single-family home, an office building, and then as you go down, you'll see all sorts of other types of properties: a rental vacation home, bare land, an office building, industrial, multifamily, and the list can go on and on. The basic idea is that any real property held for investment can be exchanged for any other real property held for investment. So the key thing to remember here is that the term like-kind property, as defined by the code, it actually can be very expansive and very broad. Now, sometimes people have the misconception that if it's bare land, you have to acquire bare land, and that's simply not true. So you can sell out of bare land, buy an income property. You can go from a single-family rental into an office, industrial, or rental property. They're all considered like-kind. Now let's take another quick look at some of these property issues. First of all, the house that the taxpayer lives in does not qualify for a like-kind property because the taxpayer actually lives in it. And then number two, as we mentioned before, property held to be sold would not qualify as well. And what's important here is the intent. The intent of the property has to be as a long-term investment. And if it's not, it's excluded. Sometimes you'll hear the term dealer property used for property held for sale. But basically what it comes down to is qualifying property is any real property held for productive use in a trade or business or investment, and it has to be exchanged for real property held for productive use in a trade or business or investment. So the bottom line here is that there are a lot of alternatives and a lot of different types of properties that meet the like-kind qualifications. So the goal here is to understand that and make sure that you find the right kind of property for this particular exchange. Now in the next slide, we want to cover the question of intent. How long do I need to hold a property before it's considered an investment? And it's more than just the period of time. It's really It's really the intent of the taxpayer and what their intent is. Is it to hold for investment or not? So the intent, it's a very internal thing and it's subjective. So what we've been told is that the IRS and the tax authorities, that they're going to look at the objective and provable facts that either tend to support the intent to hold for investment or contradict it. So either way, they're going to look at all the facts and all the circumstances. So each taxpayer's unique situation and their unique set of facts and circumstances around their particular situation is what the IRS is going to look at. So is the time period important? Of course it is. But there's no set time period that you have to hold a property for. It's really just one of the many factors in the equation. So in a perfect world, it would be ideal to have lots of factors and attributes showing that the intent is to hold for investment versus another intent. And to the extent that you might have a lot of contradictory factors, the IRS might conclude that the property was really not held for investment. And again, we always suggest that you consult with your legal and your tax advisors on this topic to just make sure you're making the right moves with your decision process here. Now let's get into the meat and potatoes of this and look at the exchange equation. So for a full tax deferral, a taxpayer just needs to meet two requirements. Number one, they need to reinvest all of the net exchange proceeds of the relinquished property, and they have to also acquire a like-kind property with the same or greater amount of debt. Now, those are the two basic rules. And another way of saying this is to spend all the cash equity and buy the same net sales price or greater. So again, to rehash this, if a taxpayer receives any cash out, that's called cash boot, and if they have a reduction in the mortgage liabilities, that's called mortgage boot. So let's take a look at a couple examples here. In this first one, the taxpayer sells a relinquished property for $900,000. The debt or the loan payoff is $300,000, and the cost of sale is approximately $60,000. Now, the cost of sale can include things like attorney's fees, settlement statement reviews, real estate commissions, things like that to make the transaction happen. So when we subtract out the debt and the cost of sale from the value, we're left with the net proceeds here of $540,000. Now, in this example, the buyer is buying up. They're buying a replacement property for $1.2 million. And in this process, the debt is actually going up from $300,000 to $660,000. So there's no mortgage boot because they went up in debt. And they're reinvesting all of their equity. So what's happening here is the $540,000 that's being held by the qualified intermediary is getting reinvested in the replacement property, and the investor is never actually touching the cash. So in this example, there's no mortgage boot and no cash boot. So we have a full tax deferral. And keep in mind, this is just a single exchange, one property for another, and an investor could actually be exchanging into multiple properties, but we're going to discuss that a little more later. Now, let's look at another example. Here, a taxpayer sells for the same amount, but they buy a replacement property for only $700,000. So they go down significantly in value. The debt also goes down from $300,000 to $260,000. So here we have $40,000 of mortgage boot. And in this example, they only have reinvested $440,000 of their net proceeds. So this creates $100,000 in boot. So here you add these two together, and the total boot analysis is $140,000, creating a tax liability of $140,000. And then finally, one last example. The taxpayer in this situation buys a property for $800,000, and they go down in debt $40,000, but they reinvest all the cash. This creates $40,000 in mortgage boot. Most investors know intuitively that if you receive cash, it's going to be taxable. But it's important that you look at both the cash and the debt. If you have less mortgage on the replacement property than the relinquished property, you also pay taxes on the mortgage boot as well. So again, to summarize, for full tax deferral, you want to reinvest all the net exchange proceeds. And number two, you want to acquire property with the same or greater amount of debt. Now, what I want to do here is give you a brief overview of the delayed exchange process and the time deadlines on this most common exchange format. What's critically important here is that you set up a 1031 exchange prior to closing on the sale of the relinquished property, the one that you're exchanging. If you've already closed, it's too late. You can't set up the exchange at that point. So in a proper sequence, you and your agent connect with the closing attorney and a qualified intermediary in advance of the sale, preferably in advance of listing the property. Your agent will then make sure the right language is in the listing agreement and in the sales contract, while the closing attorney and the qualified intermediary, they will prepare the necessary paperwork and documents to process the exchange properly. So then what happens? Once the property is sold, through an assignment of the contract to the qualified intermediary, they become the seller in the first part of the exchange. At the closing, the buyer pays for the property and the money is held in escrow by the qualified intermediary. And then the qualified intermediary instructs the closing attorney to directly deed the property from the taxpayer to the buyer. Then the qualified intermediary will hold the proceeds of the sale in escrow until the replacement property is purchased. The date of the closing of the relinquished property then becomes day zero of the identification period in the delayed exchange. The taxpayer then has up to 45 calendar days to identify a replacement property or properties, plus another 135 days for a total maximum of 180 days to acquire the replacement property and close. Once the taxpayer selects or identifies the replacement property or properties, they then will assign the contract to the qualified intermediary, who then will act as the buyer of the replacement property. When the closing occurs, the process from the sale of the relinquished property that has been held in escrow by the qualified intermediary will then be used to purchase the replacement property, at which times the qualified intermediary will instruct the closing attorney to directly deed the replacement property to the taxpayer. So you see, the taxpayer doesn't actually sell the relinquished property. The qualified intermediary does. They sell it to the buyer, and the qualified intermediary actually purchases the replacement property from the seller. So the taxpayer is merely giving up a relinquished property and receiving back a replacement property, and that's how they're able to have a 1031 exchange. They're just giving up a property held for investment and then receiving another property held for investment of it has to be a like-kind property, obviously, that is held for investment, and they never touch the cash, and that's what makes it a tax-deferred exchange. So now let's look at a little more detail on the time deadlines here with the delayed exchange. The taxpayer has until midnight of the 45th day to identify a replacement property or properties, and that's what is called the identification period. The exchange period then is a maximum of 180 calendar days. And when I say calendar days, these are not business days. These are going through weekends and holidays. They are just sequential days. So it's a maximum of 180 calendar days, or the date the taxpayer files their tax return for the year of the transfer of the relinquished property, whichever is earlier. They want you to do this within the year you're filing the tax return that's going to include this property transaction. This is another reason why you'll want to plan this out and counsel with your tax and legal advisors. You just want to make sure that you are going to be able to get this done within the proper time period. So now we have some identification rules that we're going to talk about. Now, the first is called the 3 property rule. Here, a taxpayer can identify 3 replacement properties of any fair market value. As an example, they can sell a property for $1 million, and they can identify one at $1 million, one at $1.8 million, and one at $2.4 million. The value doesn't matter, but you are limited to 3 properties under the 3 property rule. Now, second is the 200% rule. This is a rule where taxpayers can identify an unlimited number of properties. However, the total fair market value or aggregate value of all the replacement properties identified cannot exceed 200% of the fair market value of the relinquished property. So in this example, if I sell a property for $1 million, the taxpayer can identify as many replacement properties as they want, but those properties can't go over a total of $2 million in value, which would be 200%. Now, with the 3 property rule, you're limited on the number of properties, but unlimited value. With the 200% rule, it's really the opposite. It's an unlimited number of properties, but now you're limited on value to no more than 200% of what you sold. And finally, there's the 3rd rule called the 95% rule. This rule is used by a taxpayer that wants to identify more than 3 properties and more than 200% of value of their relinquished property. Now, with the 95% rule, they can do that. However, they must actually close on or acquire 95% of the value of all the properties identified. So, as an example, if I identify 10 properties, I would actually need to buy all 10 of them, presuming that they were all the same value. If I only bought 9, that would be 90%, which would not qualify under the 95% rule. So most taxpayers will typically use the 3 property rule or the 200% rule, but then there's the 95% rule to offer a little extra flexibility. Now, this slide is in here to simply expose you to some other more complex variations. The first one we're going to look at here is the reverse exchange. This is called a parking arrangement. This is where a taxpayer is going to close on the purchase of the replacement property before closing on the sale of their relinquished property. So they buy a new property, close on it, and then they have 180 calendar days to sell the relinquished property. Now, the next 2 are very similar. First, we'll look at the improvement exchange. This is where a new property is going to be built. Could be from the ground up, could be improvements, refurbishments to an existing property, but in some way, the property is going to be improved. And again, there's only 180 days to make the property improvements, so there's a very limited time frame here to do this. And then finally, there's a parking arrangement known as a reverse improvement exchange. This is where the taxpayer is going to acquire a replacement property and then begin construction on that property and then have up to 180 days to close on the sale of the relinquished property. Even though we're not going to go into a lot of detail here, this is to show you that the 1031 has a lot more flexibility than most people realize. Many people are already familiar with Section 121 of the Tax Code. These are the rules for tax exclusion on the sale of a principal residence, and I wanted to review it here now and show you how it can apply in an investment scenario. While Section 1031 provides for rules used for tax deferral on any property held for investment or used in trade or business, Section 121 provides for tax exclusion up to certain thresholds for your primary residence. So to qualify for the tax exclusion under Section 121, you have to have lived in the home as your personal residence for 2 out of the last 5 years. And if you had, and if you're a single filer, you can exclude up to $250,000 of gain. And if you're a married couple filing jointly, you can exclude up to $500,000 of capital gain. Now, when it comes to 1031s, you'll see that there's some different things that can be done in relation to Section 121. Now, we're not going to go into a lot of detail with these, but I want to share with you some ideas just to give you some other things to think about. Now, on the slide here, we've talked about the first 2 bullet points already, so I want to start with the third one down. Now, this is what we call a split treatment. This is where somebody can sell a property that's partially a rental property and partially a primary residence. This would be something like a duplex or a fourplex, where somebody lives in one unit and rents the others out. Now, there's a fourth variation here where a taxpayer converts a rental property acquired in a 1031 exchange into a residence down the road. That's another way of utilizing the two of these together. So that would be converting a 1031 property into a 121 property. And then finally, the last bullet point here is a taxpayer can convert a personal residence, a 121 property, into a rental property and then treat it with a 1031 tax exchange later. So just a couple ideas to give you some things to think about. So in conclusion, I'd like to go over briefly what we've learned today. We've discussed what a 1031 tax deferred exchange is and why now is a great time to take advantage of the exchange. Why someone would want to do an exchange. What are the motivations out there for people doing these exchanges? We've discussed the 4 different levels of taxation that you might incur should you sell a real estate asset without doing a 1031 tax deferred exchange. We've talked about the definition for like-kind property and what that means and how flexible actually that definition is. We've also reviewed the exchange equation and looked at a couple examples there, and we've talked about the delayed exchanges and the time requirements involved with those. We've covered the identification rules for replacement properties, and we've also gone over what parking arrangements are. We've discussed the 1031 and the section 121 of the code and how they can work together to create a lot of flexibility in your real estate strategies. And last, we didn't really touch on this a whole lot, but you've heard me mention the term third-party intermediaries. Now, I won't go into a lot of detail on this, but what a third-party intermediary is it's a company that helps you, your real estate agent, and the attorney facilitate the transaction of a 1031 exchange. It's a vital part of the process, and you honestly can't do a 1031 exchange without a third-party intermediary. So I would lean on your trusted legal and financial advisors, as well as your accountant and your real estate agent, to direct you in the right direction when it comes to selecting a third-party intermediary to help you with your 1031 exchange. We've worked with several different ones over the years, and there's a lot of great companies out there to choose from. I hope this presentation has given you a greater understanding of what a 1031 tax deferred exchange is and how you might benefit from using it with your investment strategy. As always, I encourage you to do your research and counsel with your tax, legal, and financial advisors to determine if a 1031 exchange is right for you and your particular investment strategy. And if you'd like to discuss your real estate strategies with me, I'll be happy to help you any way I can. I can provide you with a free performance analysis on any investment property that you own, and I can also provide you with a free market value analysis on any property that you own. My goal, as always, is to help people make wise decisions with their real estate and help them grow generational wealth for their families for years to come through smart real estate investing. So again, thank you for watching this presentation. I'm Bill Bird with Keller Williams. I hope to see you soon.